Good morning, everyone, and welcome to this TriggerCharts Friday morning pre-market rundown. I'm your host, Kevin Hoffman. We'll be discussing quite a bit today, but first, before we get started, the important disclosures: investing involves substantial risk. Past performance is not a guarantee of future results, and a loss of original capital may occur. Please consider this for educational use only, and as always, use your best judgment when investing. All right, guys, very good morning to you. Markets are continuing to be resilient this week, taking back pretty much all the downside from the previous week. Let's take a look and see what we've got on the agenda today. As always, these ongoing themes to consider. COVID is always at the top of the list. Federal Reserve, probably right in the middle there, right in between COVID and or first and second on the Federal Reserve. Supply chain and inflation still continues to be one of the ongoing themes. And this infrastructure bill, which there was some talk yesterday that the Democrats may have something on the books and may be able to get something passed today. Market is expecting around $2 trillion. I think it started somewhere around $4 trillion or something like that. So it's been whittled down. Who knows how much impact it'll actually have. But again, market is looking for $2 trillion. So watch for that to come out today. We'll talk a little bit about economics. We'll take in on the indices. Take a look at some of the COVID updates. Last week, I had a little bit of trouble trying to explain why people aren't returning back to work. I found a great article that we can take a look at today that should make it a little bit more obvious and why I couldn't put my finger on it in the first place. Bitcoin, the ETF got released sometime this week. I think it started trading 3 days ago or so. But the symbol's BITO. We're going to talk about why this isn't exactly the best index or investment for Bitcoin. You know, certainly investing in the cryptocurrency itself is always the best, but this is an option for a little bit more ease. We'll discuss the Federal Reserve. There were some interviews this week, as well as the Beige Book was released. Earnings, and we'll talk about some other tools that we use. Just to get going here, I want to just talk about some of these other tools that we use before we get into some of the charts. So I'm going to pull this stuff over here. Let's see if I can pull this here. This is one of the ones that we use to try and keep up on markets on an intraday basis. I'm going to put this into the chat box here. It's called Financial Juice. But basically, it's a little blurb rundown. I don't know if you guys can see my screen. Hopefully you can. But they have little blurbs in and out, and they also have a little bit of a squawk box going on in the background that tells you about things that are important that are going on. Right now, not much going on because it's pre-market, but you can see that they start stuff, 8 a.m., even earlier than that. They have a European market wrap up. So kind of an excellent place to get some news as well as some earnings. You see American Express came out with earnings. So this is a great tool for you guys to check out if you don't already have a squawk service or some sort of a news flow type service. Financial Juice is one that we use here for TriggerCharts. One of the other ones to get economic data, we use this site called Trading Economics. I'll put that one also in the chat box here. But this kind of gives you a synopsis of what's going on, what's set to come out, what has already come out. So I actually have this set for a filter for next week. So you'll see you have the Chicago Fed here on Monday, house pricing indexes coming out on Tuesday, get some of the EIA crude and distillate and gasoline numbers that get popped through here, durable goods orders. That's going to be an important one for next week. Obviously, Thursday, GDP will be extremely important. So watch that, as well as personal spending and personal income. So another great tool for you guys to check out. Those are the two good ones that we use. Y-Charts is another one, but it's also rather expensive for retail traders. Those two ones are free, so two good ones to check out. In economics this week, we had housing starts come out. They were a little light at 1.55 million versus 1.62 million expectations. Building permits also light, 1.58 versus 1.68. like to take a quick look at two of the big home builders here. You have Lennar, which if we take a look here on the weekly chart, we're starting to get into this consolidation mode, and we're in this this trading range here anywhere between 93 and 106. So need to watch and see, when that's going to break out or break down. But right now, everybody seems to agree on this price range here. So we're going to trade in that range until it breaks out. As you can see, there's a lot of volume on the downside and on the upside, kind of keeping it locked in there. DR Horton, another one, very, very similar chart here. So watch for this one to either, continue to trade in this range between this $86 level to 103, or it looks like it tried to break down here a couple days ago, but with the market strength over this week, we've moved back into this consolidation zone. Yesterday, Thursday, we had initial claims coming in lower at 290. Today, at 9:45 a.m., just be on the lookout. Flash PMIs coming out. I think the market is looking for some data to trade off of. On the composite level, they're looking for 54. Services looking for 55.1 and manufacturing for 60.3. So watch for that to come out at 9:45 and tread lightly on the trading there. So looking at the indices, I don't know if you guys were here with me last week, but I talked about there being some well-defined upside resistance to tackle on the U.S. indices. I was obviously wrong because we just creep and creep and creep higher here. And I kind of asked whether it was the beginning of a downtrend or just a minor speed bump. Seems like markets seem to think that it's just a minor speed bump. Let's take a look at the SPY here. You'll see that we're topping off here almost to all-time highs. So we do have this level on the SPY to tackle here before we can move higher. But certainly strength in markets has been, or the risk has been to the upside lately, despite, breaking through these levels. I think last week I was talking about, there being some resistance here in this 443 to 445, and we seem to bust right through that rather quickly. So where we go from here, the upside may be the risk, but looks like at least they're trying to beat up on the all-time highs here, at least on the SPY. Russell still stuck in this range. These are the small cap stocks. You can kind of see here we still have quite a bit of resistance on the upside here on the Russell, but also trading on the downside here for 214 all the way to 233. So a pretty wide range, but consolidation here on the Russell. As you can see on the Aileron, we're getting these overheated type crosses here on the Russell on the daily. So there may be some pressure coming in on the Russell to push it back down into this consolidation zone here on the weekly. NASDAQ, fairly similar as the S&P, but still not quite making it to the all-time highs. Still quite a bit of resistance here up on this 378 level all the way up to 380. So watch for markets to try and push on those today, depending on what this flash PMI number is, or what we have coming for economics next week. One thing that I've been looking at, and which JP Morgan actually mentioned in one of their write-ups this week, is the MOVE index. And I'm not sure if you guys are familiar with the MOVE index. We're all familiar with the VIX index, which is kind of the fear index, and it's option volatility in the equity indices, or in the equity space. The MOVE index is option volatility in the bond space, bond indices. It tracks implied volatility based on contracts in the 2, 5, 10, and 30-year treasuries. Now you can see there's this divergence here on the MOVE index. So we're seeing some option volatility come into the bond index, but the VIX, the black line here, has been coming down. So there's this large divergence. Now JP Morgan has cited that many times in the past, this is a bit of a cause for concern. And the reason for this is because a lot of people kind of see bond traders as the quote unquote smart money. Now, they've been wrong many times in the past, just as similar as equity traders, but certainly it's something to be careful of and watch for this large divergence here with the VIX being on the low side and the MOVE index being on the high side. The MOVE index it's a Merrill Lynch product that was developed, and it's an estimate based on the yield curve or a weighted index of the yield curve for those 2, 5, 10, and 30-year treasuries. So whether or not there is an issue coming, it's just something to take note of and have a look at. But the MOVE index is something you certainly want to keep your eyes on. Last but not least, on the indices side, I wanted to take a look at EWZ. This is the Brazilian ETF. It's been absolutely clobbered over the past, I guess, what are we looking at here? Past 6 months or so, maybe a little bit longer, moved from 42 down to 30. Based on this, its forward price to earnings is at 6.9. That's the second lowest level on PE, next to Turkey. I think is the least or the worst as far as a PE level goes. So, not like I'm trying to catch a falling knife here, but just something worth looking at here, especially on the weekly chart. You can see that there's some downside support here on this EWZ, and worst case scenario we have down to about 28 or so. So you can put some tight stops in there, but something to watch for here. You've also got a little bit of a short-term uptrend. If we take a look where it bottomed out here in COVID levels in early 2020, we have a slight bit of an uptrend here. It did break this particular trend line here on the weekly chart, but certainly some downside support here on EWZ. So something to consider and watch going forward if you're looking for something in the emerging market space. If you guys have any positions that you want me to take a look at, feel free to put them into the chat box. Be happy to take a look at them and go from there. Here. Moving on, some COVID updates. As far as Russia goes, this is interesting. Russia's had some really difficult problems with COVID. They have their own vaccine that they've created. I think it's called the Sputnik vaccine. But they're having a real difficult time getting people to accept it. I think they only have about a 35% vaccination rate. And on Wednesday, they had a record number of cases and deaths, recording 34,000 or so cases, 1,000 plus deaths. However, their equity markets don't seem to care, and a lot of that has to do with the fact that Russia plays a lot on energy type trades and commodities. So, even though they're having some trouble with COVID, the increased commodity prices certainly is helping out their long-term prospects. But Moscow is setting to shut down all shops except for grocers and pharmacies for about a week or so. So something to consider to watch here on Russia here and the RSX index. In other news, Novavax, they're reporting another delay to their vaccine. I don't know if you guys watch this stock or not, but it's dropped last couple of days rather precipitously, moving down here from 260 or so all the way down to this $126 level. There was a report from Politico that the company is facing some significant challenges in proving that their vaccine that they're manufacturing, that they can meet the regulators' quality standards. So this particular vaccine that Novavax is making was supposed to kind of put a stopgap in for some of those low and middle income type countries that either can't afford or can't access the Pfizer, BioNTech, or Moderna vaccines. So there was a lot of pricing in here on Novavax that they'd be able to get this out and produce quite a bit of doses for those low to middle income countries. However, certainly we've seen that on think it was yesterday or 2 days ago. It was down almost 25% midday, and it's down a little bit more than 40% over the past several weeks. As you can see on the weekly chart here, kind of dropped down to the support position around this 130 to 132 level. So it may find itself some support here and move back up if they can continue to produce that vaccine. But certainly a lot of support down here on Novavax for the downside. Last but not least, in the COVID world, we're seeing some increased vaccine mandates go into effect for employers and municipalities alike. This is in response to trying to meet I think Biden put into effect that December 8th, all government and government contractors will have to have the vaccine mandated for their employees. So many companies are starting to try and push this in. GE recently announced this, Union Pacific, Disney, IBM, and most airlines. However, a lot of companies are still waiting for OSHA to put out their report and whether or not they recommend that employers institute this or not. However, with the December 8th mandate coming, anybody that does business with the government, whether it be selling parts like Lockheed Martin or providing services, will be required to have this vaccine December 8th unless it gets overturned by the courts. But it seems like many companies are pushing this. So watch for this to continue going forward. One thing I struggled with one thing I struggled with last week was this reason why people are not getting back to work. And CNBC put out a really good article. I'm going to punch it into the chat box here. Makes it really, really obvious. And we'll just kind of go through some of those reasons. But obviously the fear of COVID continues to be one of the top things. Early retirement, which I didn't quite realize this, but 3.6 million people that are currently out of the labor force are 55 plus. So that's about 89% of those people are 55 plus. So they're getting out of work, retiring early, kind of deciding, if they really want to go back to work or if they want to, kind of explore or travel or do some of those things that they didn't get to do while working in life. Another reason cited, there's about 1.8 million people that are indicating that they're not working due to the fact that they're caring for either somebody that is sick with COVID or an elder or a child that they've decided that the cost and fear of either putting their child in childcare or their elder into an assisted living facility just isn't worth it for them. So that's another 1.8 million people there on that front. Another reason is savings. It seems that based on a study here, households have quite a bit banked up in their savings in their bank accounts lately. Savings accounts are up 50% since July of 2019 to July 2021. So over a 2-year period, despite COVID, bank accounts are up more than 50%. That's rather impressive. The other reason is wages really haven't caught up to what people are expecting. We're only seeing about a 4.5% increase on wages, or about $1 per hour. So that's just not enough to attract people back to work, despite some of these COVID risks. Lastly, time heals all wounds. It's just going to take some time for people to get back to work. But these are some of the most, I really struggled last week for some reason trying to explain it, but this really puts it into perspective. So something to consider and watch going forward. Let's see, where are we at here? Let's take a look at some of these stocks. You guys have quite a bit that you're looking at. We'll go through some of these. EXPE. This is Expedia Group, travel. Certainly starting to see a little bit of a roll down here on the daily. On the weekly, a lot of resistance on the upside here. Certainly you kind of have this trending down. But on the daily, let's see if we've got some support at least on the daily down to 157, and on the weekly also beating that here at 155. So still looks like it's consolidating, at least on a daily perspective. So not really much to go off there on that one. Natural gas, this one's going to be a wild one. Trading a lot on news. Going to be hard to trade on technicals with this one, but certainly some upside resistance here. A lot of price at volume at price here on UNG, but certainly with the winter coming, we never know if it's going to be a cold winter or a warm winter, and how much supply there is. Certainly with these vaccine mandates, there are going to be some people walking off jobs as well, so supply may be stunted. So be careful with this one. It's highly volatile on UNG. Let's see. All right, let's move on here. Federal Reserve. That's one of the last themes, one of the major themes that we have here. They released their beige book. Now, what is the beige book? The beige book is a report that's published 8 times a year, and it's basically, I'll call it anecdotal or opinions that the Federal Reserve Bank members have, where they're speaking with local business members, checking on economic conditions in their districts, and reporting back to the Fed chairs. Some of the major bullet points that we saw is many of the members saw only a modest to moderate growth increase. They believe that some of this pace has slowed due to supply chain issues, lack of labor, and also the fear of the Delta variant. However, on some of the most robust growth we saw was in manufacturing, trucking, and freight. Now, there's been a huge problem with getting labor in the trucking space, so we're seeing a lot of growth there, just not a lot of supply from manpower to fill that. Most districts are seeing significantly elevated prices, but they're also citing that corporations are able to pass on this price. It seems that consumers are more willing to pay higher prices as long as they can still get those goods. And despite previous large demand in auto sales, they're seeing a decline in auto sales, and that's mostly due to the low amount of inventory that's available and customers starting to shy away from those high prices on at least automobiles. Firms also reporting that they had higher than normal turnover, and workers are left for other jobs or retired. That's kind of something that we discussed earlier on why Americans aren't getting back to work. Somebody has said I should maybe go back to the other screen. Which one are we looking at here? Do you guys see charts right now on UNG? Yeah, that's fine. I'm just kind of going through some of the Federal Reserve stuff, but I'll also pull up one thing that's interesting here from the Federal Reserve perspective is this FOMC. This is the Fed Fund futures that we're looking at here, and it's predicted. These are the probabilities based on meetings as to what interest rates or when interest rates will increase. So you'll see here on June 15th of 2022, this is the first time that it's a higher probability that there'll be a 25 basis point increase here, with approximately 61% thinking that there's going to be a hike here on the June meeting, and they're looking at December that there'll be at least 2 increases. So this is something to watch going forward. I'll paste this one for you guys to look at in the chart or in the chat box as well. Yeah, so they're looking at first hike around June-July meeting, and then second hike around this November-December meeting. Let's move on. Take a look at some more positions. We have quite a few positions that people were looking at early this morning, so I'm going to go through some of these here. KWeb, I believe this is the Chinese internet companies. I think this is one that Andrew's been watching for quite some time here. Looks like he drew this consolidation box here on KWeb. and it seems to have continued forward here on this consolidation. Looking for a potential breakout, maybe if it can get above this high level here of 55.30. So that's a good point to consider to be long, or to look for support on the downside here anywhere between 45 and 47. So thanks for putting that one in the chat box there, Anonymous. ATOM, Atomera. Not sure if I know. Let me see if I can pull this up real quick. Atomera, what do they do? Semiconductors. So a lot of problems in the semiconductor industry, getting chips, making chips, but certainly, again, consolidating here. Got downside support around this $21 level, with certainly upside potential if we break out above this high line here. REE Automotive. Is an electric vehicle platform. So going to be a tough one on electric vehicles, especially newcomers to the market. Tesla came out with earnings this week. Earnings were, they blew it out of the water. It was $1.86 versus $1.67, and revenues were $13.76 billion. They were expecting 13.91. So revenues were light, but this was on much higher margins. They were expecting 24.2% on their operating margins, came in at 26.6. So that just implies higher profitability. And as you can see, Tesla reacted quite nicely to that, moving up to the high side here. But REE, I think it's going to be reactionary based on news. It's going to be tough to trade that if it's based on electric vehicles, on technicals. Certainly on the daily, you have some downside here, but we're on a pretty monster trend down from about $11 to $4. So I'd be careful with that one. This is Rio Tinto. Mining and minerals, certainly with infrastructure bill, even though it's getting pretty skinny, could help on the upside. Got a nice long-term uptrend on Rio. Certainly quite a bit of downside support here in this $59 level. That's about $5 away right now. So if you're trying to catch that falling knife that's come down from 90 to 65, some good support here down at the $59 level, or certainly looks like it should continue on the downside, at least until that particular level. I'm trying to think, is there any other stocks I'm looking through here? Not seeing anything. Some other earnings that came out. This is an interesting one that we could talk about here is AT&T. This chart looks absolutely abysmal, but something that's worth discussing here on AT&T is the fact that even though the chart doesn't look so great, they do pay out a pretty significant dividend. So a lot of times it's difficult to do some technical analysis on these companies that do pay out on big dividends. As you'll see in this total return price chart here, this is over the last 3 years. So despite that chart looking pretty ugly, which, let's be honest, it still is ugly, over the last 3 years, the price chart is down 21.63%. However, if dividends that you got from AT&T were reinvested, you'd only be down 4.37%. So it's just something to consider with some of these dividend-paying stocks. They did come out with earnings, and they beat pretty well. I think they came in at 87 cents versus 80 cents expectations, and $39.9 billion versus $39.14. So this is a lesson on why technical analysis can fail sometimes to predict with, especially longer term charts for dividend paying companies. But AT&T getting a nice boost this week despite some of this downtrend here, moving from this $25 level, breaking up above this 26. As you can see, on a daily chart at least, we've been in a long-term downtrend. It was a short here when it broke down from this $28 level all the way down to about $26.80 or so, And then again, we were short down to here and got stopped out around 25. So it's breaking up above the most recent altimeter here. So watch for that to potentially move up higher. Not a lot of, price movement here. We're talking about 27.30 to 26. So not a highly volatile type stock in AT&T. Another company that came out with earnings was Netflix. Netflix beat pretty good here, 456 versus 259 on big revenues, 1.97 billion versus 1.76. Oh, I'm sorry, that was Ulta. Netflix beat 319 versus 256 on big revenues of 7.48 billion, in line with expectations. They saw subscriber growth of 4.4 million, which just absolutely blows my mind. And they're looking to add 8.5 million in the fourth quarter of this year. So Netflix is just absolutely crushing it, and they're continuing higher. So guys, thanks for joining me today, and we'll look forward to seeing you next week. Andrew's back from vacation, so you'll have him for Friday of next week. Take care, guys, and have a good day.